Hi, accounting class. Today's a great day to do some accounting. Today we're going to be looking at chapter 1, which is an introduction to accounting. In this chapter we're going to define a bunch of different terms that we're going to use throughout the course. So most of this chapter is just definitions. We're going to start off by defining what accounting is. Accounting is an information system. This information system provides reports to users. Later we're going to see these reports are called financial statements. The users, we're going to define in a second. The two major users are investors and creditors. The whole purpose of this information is to enable users to make better informed decisions based on data, i.e. where do they invest their money. Accounting is often called the language of business because in order to describe transactions, especially the higher you get into a business, the more accounting language will be used. So accounting is used to describe business events. Alright, the accounting profession can be divided up into two fields, financial accounting and managerial accounting. Financial accounting aims to provide information to external users. External meaning they're outside the business. There are two major types of external users. It's the investors and the creditors. Alright, investors and creditors are similar because they both have money or capital that they have put into the business. They just have a different legal agreement in exchange for it. Investors are people who have invested capital into a business and then in exchange they get a partial ownership in the business. Alright, so their investors are going to be partial owners. As a benefit of being a partial owner, they have a right to the future earnings, or at least a portion of those future earnings of the business. So they're interested in how it performs financially because they have basically money on the line here, the right to the future earnings. Creditors are also people that have contributed capital to the business, but they have simply just lent it. It's a legal agreement, and they're going to be repaid their principal plus their interest. So the creditors are interested in how a business does, so that they can ensure or get reasonable certainty that the principal and related interest will be repaid. Alright, managerial accounting we're not going to look at too much in this course because it's the whole another course at San Jacinto College. So we're looking only at Accounting 2301, which focuses solely on financial accounting. There's a whole nother course for managerial accounting that we'll cover. But managerial accounting does provide information instead of external users to internal users, such as the executives, managers, and employees. Basically, decisions that help them run the business better. Things like budget, some things like how many units do we have to sell to break even, what sales price should we have in our unit, how many units should we produce, all these other different types of decisions that occur inside the business. But we're going to be focused solely on financial accounting in this course. Alright, because financial accounting provides information to external users, we all have to play by the same set of rules. These rules that we play by are called generally accepted accounting principles. Basically, these are the laws we have to follow in preparing financial records. So it's called generally accepted accounting principles, or GAAP for short. These are the rules we must follow if we're providing information to external users. Alright, so how are GAAP rules determined for us? We're going to go with the definition that FASB creates GAAP. Yeah, the real answer is a little more complicated. It's like law, they're similar. There's different layers to this of support, but the FASB is the highest level of support besides the Congress itself. The U.S. Congress gives FASB the power. So for our definition, we're going to go with GAAP being the rules and FASB being the rule maker. Alright, but both of these are within the United States. We have US GAAP, and the FASB is a US organization that creates GAAP. Other places in the world have tried to get together and agree on one worldwide standard, and that standard is called IFRS, or International Financial Reporting Standards. The US currently does not follow this system. I don't know how likely it is that they're going to follow this system ever, but they go at one point was to converge the standards so everyone's playing by the same set of rules globally. So it's very easy to compare a country, say in the US versus one in Europe. Alright, so let's get back to GAAP concepts. We're going to start by defining three. One is the cost concept, the second one is the business entity concept, and the third one is materiality. Alright, the cost concept is actually very simple. It just says we're going to generally record transactions at their cost or transaction price. So what price they change hands at, that's their transaction price. We can read through this example. We have the owner of this business. We're going to see this business throughout the text, paws and claws. It's an imaginary business, but it provides veterinarian services and grooming services. Janet's the owner of it. So they're looking into buying a retail office. The property is listed at $185, an appraiser valued at $178, initial offer of $180,000. But here's the actual transaction price. She negotiated down to $175, which was accepted by the seller. So this is the transaction price. This is the only number that matters. So we're going to record this on our books at $175, not the $185, not the $178, not the $180, but $175, because that's the transaction price. The reason GAAP prefers this is that this number is very reliable. We have an invoice to tie it back to. So it's a very reliable number. That's why GAAP prefers recording things at cost. Alright, business entity is also a pretty simple one. Business entity concept states that a business transaction should be kept separate and distinct from any other business or the owners. For example, a business owner's personal expenses should not be recorded in the business's financial record. So the business is its own separate economic entity. Only transactions that affect the business should go in their records. The last one here is materiality. Alright, materiality basically means if something's large enough to make a difference. Something is material if it's large enough to make a difference in a reasonable person's decision. So in accounting we deal with all different types of balances. Some of them are very small. If they're very small, we call them immaterial. If they're immaterial, the GAAP rules are a lot more flexible in dealing with immaterial amounts, because it really doesn't matter. It's such a small amount that we're not going to necessarily have to follow the appropriate method that GAAP recommends if it's immaterial. But if it is material, GAAP has very specific rules on how we need to treat those amounts. So the word materiality just means it's significant enough to make a difference in someone's decision. On the next page, we're going to look at the different legal structures of a business. We're going to look through 4 types. Be aware there are more than these 4. We're going to look at a sole proprietorship, a partnership, a corporation or a C Corp. There's also an S Corp, that's why this one's called a C Corp, but we're not talking about the S Corp today. And a limited liability company or LLC. These are the legal structures of a business, and it affects different attributes. The different attributes it can affect is their ability to raise capital. Again, capital is just like resources or money that the business can use to invest into different projects and earn a return. So the different forms affect their ability to raise capital. An important one here is legal liability. So the business structure may have unlimited liability or limited liability. For example, imagine if we're in this pet grooming service went terribly wrong before a big show, the customer decides to sue as a result of the lost fees. If the business has unlimited liability, then the loss from the lawsuit can go beyond the business assets to the individual owner's individual assets, their personal house, their personal car. That's very bad news, right? So the business form, this is a negative thing. If a business has unlimited liability, that is a negative attribute to it. On the other hand, some business forms have something called limited liability. Under limited liability, our losses are limited to the amount that we have invested. So only the business assets are used to satisfy legal judgments if they have the limited liability. Alright, tax effects. There's really only one negative tax effect here. It's called double taxation. Alright, the corporation is viewed as a separate legal entity under state law. Because they are viewed as a separate legal entity, the IRS taxes them as a taxable entity. So the IRS taxes the corporation pays income tax. Now what money is left over, the corporation can pay out to the owners in the form of a dividend. But when they do that, pay a dividend to the owners, the IRS also views that as a taxable event to the individual. So the money is being taxed twice. It's being taxed once at the entity level and then again at the individual level. And this is a major disadvantage of corporations. Alright, let's go through these. We're going to group sole proprietorship and partnership are basically the same thing, except partnership has 2 or more people. Sole proprietorship is the most common type of business structure. We want to be careful with that wording, and the word we see here for corporations are the most significant. They account for 90% of business revenue. So if a question asks you the most common type, it's sole proprietorship, but be aware that corporations are actually the most significant type because they account for 90% of them. So there's smaller in number, but they're a lot bigger in size. Sole proprietorship, there's a ton of them, but they're small in size. Alright, by default, a business is a sole proprietorship. So if you start earning money and don't file what type of business you are, by definition, you're a sole proprietorship. So it is the default business type. A disadvantage is they're generally limited to the resources of the owner. So they don't have a great way to raise capital. That's why most of them stay small. And they have unlimited liability. This is a very negative point about sole proprietorships. Partnership has basically the same definitions as sole proprietorship, except it has 2 or more people. Other than that, so it increases its ability to raise capital by a little bit, assuming that other person has more capital. Other than that, they're very similar in nature. Corporation is the most different one here. Corporation is a separate legal entity formed under state law. The law almost treats it like it's another person in a lot of ways. What also makes it unique is that it can split ownership of itself into many shares of stock and then sell that to the general public. So it can split ownership of itself into shares of stock, sell that, and that allows it to raise large amounts of capital. Corporations also have limited liability. So they have this good news. We want the limited liability. So they beat out the sole proprietorship and the partnership there. But they have a major disadvantage that we've already talked about, the double taxation. The earnings are effectively taxed twice, once at the corporation level and then once at the personal level when they pay a dividend to the owners. But they are the most significant type of business in America. So we're going to be using our focus primarily on the corporate form whenever we do accounting. Alright, LLCs, limited liability companies. This one basically gets the best of both worlds. It has limited liability, like the corporation does, and they do not experience the double taxation effects like a corporation. So if I was going to start my own business, this would be the one that I'd be most likely looking into, as an LLC. Alright, the next page, very important, the accounting equation. Assets equal liabilities plus stockholders' equity. Assets equal liabilities plus stockholders' equity. Assets equal liabilities plus stockholders' equity. This is referred to as the accounting equation. It's very important because it's going to make up the foundation of the balance sheet that we're going to see later. But this is also an equation. Just like in math, you can subtract liabilities from both sides and you'll end up with an equally true statement. Assets minus liabilities equals stockholders' equity. Alright, what we're going to do now is define these 3 terms, and on the next page we're going to have 3 more terms: revenue, expenses, and dividends. Very important, these 6 terms, because every account is going to fit into the definition of one of these 6 terms. It's either going to be an asset, liability, equity, revenue, expense, or dividends. So it's important for us to know the definition so whenever we see an account we can label it correctly as one of those 6 types. Alright, assets. What are assets? Assets, the FASB definition defines them as probable future economic benefits. For us, in the introductory course, we can just say they're resources owned by a business. So we have things like cash that the business owns. We have accounts receivable. Accounts receivable is when somebody else owes us money. If they owe us money, it goes into accounts receivable. This accounts receivable is likely to become cash in the near future, assuming that they pay us. But that's what it is, when somebody else owes us money, owes the business money. Supplies, these are just supplies we have purchased and have not used up, so they're an asset. We see other prepaid expenses here, such as prepaid insurance, prepaid rent. These all, even supplies are a prepaid expense. These all fall into that category. Prepaid expenses, such as prepaid insurance or rent, are assets when we buy them, but they become expenses as we use them up. Let's go and take an example. Let's say you're buying car insurance and you want to save a little bit of money, so you actually buy the 6-month package because it gives you a lower rate. When we buy that 6-month insurance policy for the vehicle, it's an asset when you buy it. But as those months go by, that asset is going to turn into an expense. So we'd move it out of the asset account into an expense account. We're going to see that a lot more in Chapter 3. If that's a little confusing to you, we'll see examples of this in Chapter 3. Business can also have something called long-term assets, or assets that are expected to last more than 1 year, such as equipment or buildings. We'll see a little example in Chapter 3, but there's also a whole nother chapter, Chapter 8, over fixed assets, that we'll see later in the course. Alright, liabilities. Liabilities are basically the opposite of assets. So they're probable future sacrifices of economic benefits. If you want a simple definition, these are resources owed to another party. So liabilities is what we owe to somebody else. Assets is what we own. Liabilities is what we owe to somebody else. For liabilities, basically you're going to see one word for almost all liabilities. It ends in the word payable. So anything that ends in the word payable is a liability. Alright, accounts payable, accounts receivable. These are two tricky ones for students when they start. Accounts receivable is when somebody else owes us money. So accounts receivable, somebody else owes us money, it's accounts receivable. If we owe somebody else money, it's accounts payable. So one's an asset, accounts receivable, they're going to pay us money. Accounts payable is a liability because we're going to pay them money. Alright, unearned revenue is another tricky account. First of all, notice it has revenue in its name, but it's not a revenue account. This is actually a liability account. I'll go ahead and give you an example. If we're paid in advance before we provide a good or service, it's going to go into this unearned revenue account. This is a liability account. And it's a liability account because if they pay us in advance, say we have a property that we own and we're going to rent it out. They pay us 3 months in advance for that property. That money has not been earned yet, so it goes in this liability account. We effectively owe them the rent on the property. But this is an advanced concept. We're going to cover it more in Chapter 3. If that's too much for you, just try to define it as a liability in your mind. We'll clarify that in a later transaction. Alright, wages payable. Anything that ends in payable is a liability, and that's what we say here. So we're looking for that one key word. If it says payable, it's definitely a liability. You can have things like unearned revenue that doesn't have payable in it. It's still a liability though. Alright, the third type here is stockholders' equity. Alright, the FASB basically just says this is what's left over, right? If you take assets minus liabilities like we see here, you have stockholders' equity. So the official definition is basically what's left over after you take assets minus liabilities. Sometimes called like net assets, because you would take out the liabilities. Assets minus liabilities equals stockholders' equity. A simple definition here is the rights of owners to the business resources. One way you can think about this is assets or resources that a business owns, and then the other side tells you kind of who owns the asset. The business owns it, but you can see how it's financed effectively. Whether it's through liabilities, do we owe money to other parties like the bank or to bondholders, or do the owners actually own it? So assets, take a house. We own a house. If we have a personal house, it's an asset. But if we have a mortgage on it and we owe to the bank, that's part of the liabilities. The difference between the assets minus liabilities equals the stockholders' equity. And if it's for a house, it's usually called owner's equity in the house. Alright, stockholders' equity has two major components. The first is common stock. So we're under stockholders' equity, two types, common stock and retained earnings. Common stock, whenever we set up the corporation, we sell common stock to the public, that's what will increase this account. So this is externally generated. This is when investors are purchasing stock or purchasing ownership into the business. The other account is retained earnings. This represents all previous earnings of the business that have not been paid out in the form of a dividend. So retained earnings represents all the previous earnings of the company that has not been paid out in the form of a dividend. So it's like they keep all their prior earnings in this account except for the amount they pay out. Again, this is a lot of information. I know I'm just going to throw a lot at you and see what sticks. It's not all going to stick in this one. We're going to reinforce it through the first 4 chapters, so don't feel like you have to master every concept. We're going to learn a lot more about these words. In chapter 4, we're going to see a lot more about retained earnings, so I'm just trying to see what I can get stick in your mind right now, but you're not going to be able to capture everything in this lecture. Alright, the accounting equation, assets equal liabilities plus equity, forms the foundation for the balance sheet, which we're going to see later. It's also a math equation. So if they give you 2 of the numbers, you can only solve for the 3rd one. This is very simple algebra. So assets equal liabilities plus equity. If we know assets are 105, we know liabilities are 90. We can solve for equity. All we need to do is subtract the 90 from each side. We do that, we get equity is equal to 15,000. Alright, so we covered 3 of them, assets, liability, and equity. On the next page we're going to have 3 more. We're going to have revenue, expenses, and dividends. Alright, revenues. A simple definition of revenue would be resources earned by a business. So if we perform a service and earn money, it's revenue. If we deliver a good and earn revenue and earn money, it's a revenue as well. So there's basically 2 ways you can earn revenue: performing a service or delivering goods to a customer. We'll see more about this type in chapter 5. For now, we're going to focus just on a service business. This is called the revenue recognition concept. Very important here. A lot of students, when they come in, they think that the money has to be received in cash. So we had to complete a service and receive the cash for it to be revenue, but that's not true. The definition just says it has to be earned. We do not need to receive the cash for it to be earned. What we need to do to earn it is complete the job. Once the job is completed, we've earned the revenue. We can recognize it as revenue. If we're a merchandising business and we have a product to sell, it's when the product transfers from the seller to the buyer. Again, very important. The key word here is earned. The revenue does not need to be received in cash to be considered revenue. Very important. The only key word there is earned. The job needs to be completed, or the goods need to transfer from the seller to the buyer. We do not need to receive cash. It's one of the most common misunderstandings for new accounting students. Examples of revenue accounts: we have fees earned, sales that we're going to see later, and basically anything that ends in revenue except for that one tricky one, which is unearned revenue. So if it has revenue in its name, like we'll see later, grooming revenue, veterinarian revenue, the only one that's a trap there is unearned revenue. Remember, that one's a liability. Alright, expenses. If we define revenue, expenses are basically the opposite of revenue. These 2 are opposite in nature. So these expenses are resources that are used up. Revenue are resources that we've earned, where the expenses are resources that we've used up or consumed. We incur expenses because we're trying to earn revenue. The process of earning revenue, we often incur expenses, right? So if we're doing the grooming service, we would have to pay the person, the employee who's doing the grooming services. So we get revenue from the customer, but that also incurs an expense that we have to pay for. So in the attempt to earn revenue, we often incur expenses. Alright, examples: wages expense, supplies expense, anything that ends in the word expense, except for the one trap here is prepaid expenses. Remember, prepaid expenses are assets, like prepaid rent is an asset, prepaid insurance is an asset, supplies is an asset. They will become an expense over time, but they're not currently an expense because they have future value until we use them up. Alright, very similar rule here to the revenue. It does not depend on the cash transferring. So an expense is an expense when we consume it, not when we pay the bill. So an expense is an expense when the resources are used up or consumed. We're going to give you an example here. This pausing clause uses electricity for the month of January. So we use it all January, but we don't pay the bill until February when they send the bill. But the expense should be recorded in January, not in February, That's because we've incurred it in January. We've used the electricity in January. It doesn't matter that we didn't pay the bill until February. It matters that we've used it in January. So it's an expense in January because it was incurred in January. Sometimes they call this the expense recognition concept. Very similar to the revenue one, revenue recognition concept. This one's the expense recognition. And very important, it doesn't depend on when the cash is paid. Neither one of these do. So there's another basis of accounting called the cash basis of accounting, but it's not the GAAP method. What we're doing is called accrual accounting. And under accrual accounting, revenue is revenue when it's earned, expenses are expenses when they're incurred. The last one here is a dividend. The only type of dividend we're going to look at is called a cash dividend. Cash dividends are basically money that's paid to stockholders. So we can think of a dividend as a cash payment to the owners. Alright, it's very important not to confuse dividends with an expense. So they're similar. Dividend and expenses have a lot of similarities. Ultimately, there's going to be cash going out at some point for both of them. But a dividend is a payment to the owners. The owners don't think of this as an expense. They think of it as income to them. So this is a payment to the owners. Ultimately, the corporation is supposed to act in the best interest of the owners. So don't confuse it with an expense. It's a payment to the owners. It's not a consumption of resources. Alright, these three accounts here, plus these three, make up all the 6 different types of definitions that we're going to use to define accounts. So every account we talk about is going to fit into one of these 6 and only one of these 6 definitions. Alright, the last part here is a little complicated. These 3 accounts here, at the end of the accounting period, we're going to see in Chapter 4, are going to close out to retained earnings. So all of the ones on the second page, revenue, expenses, and dividends, are all going to close out to retained earnings. We're going to see how they do that. Revenues will increase equity or increase retained earnings. Expenses and dividends will decrease retained earnings. We're going to see a retained earnings statement later where it actually does the math for this, and we're going to see in Chapter 4 the journal entries for this process called the closing process. But these 3 we're going to see later are also called temporary accounts. For these 3 here, the balance sheet ones, are called permanent accounts. Yeah, so these 3 close to equity. They close to a specific equity account called retained earnings. So revenue increases retained earnings, expenses and dividends both decrease retained earnings. Alright, the next page we have financial statements. It says they're used by investors, creditors, and management. Okay. We have 4 basic financial statements. We have the balance sheet, the income statement, the retained earnings statement, and the statement of cash flows. Alright, let's get started with the balance sheet. The balance sheet, remember the accounting equation, assets equal liabilities plus equity. That's what basically goes on the balance sheet. That's the foundation for the balance sheet. The balance sheet is performed as a specific date. Let me give you an example of why it has to be done on a specific date. Imagine I asked you for your cash bank account balance for the month of February. You're going to have a question mark in your mind because, well, you're going to say it changes. I get my paycheck during the month. I have all these bills I pay. Cash is coming in. Cash is going out. I can't tell you what it is for the month of February. You can only tell me what it is or measure it for a specific point in time. And it's the same way for all the other assets, liability, and equity. The accounts are changing over time. We can only measure these type of accounts as of a specific date and time. The balance sheet is often called a statement of position because it kind of tells you where a business is at a specific date and time. All the accounts on the balance sheet are cumulative accounts. Let's go back to your bank account. If you go to the bank and ask for your balance of that bank account, they're going to give you one number, but that one number summarizes all the cash that entered or left the business for the entire history of the business. That's what it means to be a cumulative account. In Chapter 4, we're also going to call these permanent accounts. Permanent accounts are never zeroed out, so these accounts will never be zeroed out. We're going to see the income statement, revenue, expenses, and dividends are going to be zeroed out, but balance sheet ones are permanent. They're never zeroed out. A balance sheet is like taking a financial snapshot or picture of a business at a specific point in time. The income statement. The income statement lists out all revenue and expenses for a period of time. So it lists out all revenues and expenses for a period of time. Now these you have to measure. They're streams of data. You have to measure them over a period of time. Let's go and define what net income is for us. Revenue minus expenses. That equals net income. It says here if the expenses are higher, then the term is called net loss. But in general, I think of this as the formula. Net income equals revenue minus expenses. Again, they're measured for a period of time. Revenues have to be earned over time. It makes no sense to ask what it is at a specific point in time. You have to measure it over a period of time. Alright, these accounts are not cumulative. Remember, balance sheet ones are cumulative. Income statement ones are not cumulative in nature. They only represent the values for the period being measured. Whether we're measuring revenue and expenses for a month or a year, it's only for that period. It's not for the entire history of the business. These we're going to see in Chapter 4. These accounts, revenue, expenses, and later dividends that we're going to see on the retained earnings statement are all closed out. So they're referred to as temporary accounts. They're going to be closed out during the closing process in Chapter 4. An income statement isn't like taking a snapshot, it's more like a motion picture. It occurs over time. And it can indicate the direction a business is heading. So a balance sheet kind of tells you where a business is at a specific point in time, where an income statement tells you kind of the direction. Are their earnings increasing over time, for example? Are they growing over time or not? The third one is the retained earnings statement. Here's the formula for it. Let's just go through it. Beginning balance of retained earnings plus net income. Remember, net income we just defined as revenue minus expenses minus dividends equals your ending balance of retained earnings. It's very similar to your own bank account where you start with the beginning balance. Well, the beginning balance for this account is called beginning retained earnings. You add to it the money you deposited during the period. Maybe you worked and got a paycheck directly deposited. For the business, we're going to call that net income. And then money you withdrew for yourself, we're going to call that dividends. And you get to your ending balance. So we keep track of the beginning balance, what came into the account, what left the account, and then we get to our ending balance. But it's just going to help you to remember this. We're going to see it especially throughout the first 4 chapters. Again, the definition of retained earnings. It's a tricky account, but it represents all the prior earnings of the business that had not been paid out in the form of a dividend. So it's a cumulative permanent account. That's why it starts with the beginning balance. It adds to it net income, so all the revenue and expenses we earned during the period, and then subtracts out dividends. Because this money effectively left the business. We pay it out to the owners of the business, so it's no longer retained in the business. Fourth one is statement of cash flow. We're going to have an entire chapter over statement of cash flow in Chapter 12, so we're not going to talk much about it here. We just want to put it into the discussion because it is one of the basic 4 financial statements. Alright, let's look at examples of financial statements. On the next page, we're going to have an example of all 4 of them, basically. Alright, starting with the income statement for the month end, and notice the wording, notice the title. We have 3-part title to this. We have the name of the business as the first line. We have the statement, or whatever type of statement we're making. In this case, it's an income statement. And then we have the date or date range that it covers. For this income statement, remember net income is revenue minus expenses. So this one just lists out all the revenues here and totals them up. So we get total revenue. Then it lists out expenses. You're going to notice the theme with these expenses, they all end in the word expense. We add up all the expenses, we get to the total expenses. Last step is taking total revenue minus total expenses to end up with net income. So that's the income statement. List out all revenues, list out all expenses, subtract the 2, you get to net income. For the retained earnings statement, we're going to have the name of the business, retained earnings statement, again for the month ended January 31st. It starts with the beginning balance. Notice they're saying this is the beginning balance. That's what it was on January 1st, and this is indicating the ending balance. They add to it net income. Notice this relationship between the income statement, the 7721, basically goes here for the net income because it is the income for the business for that period. Alright, you subtract out dividends and you get to the basically the increase in retained earnings. So 7721 minus 2500 is 5221. We take the zero balance for this business plus the 5221 and get to the ending balance. This one started off with a zero balance because all businesses start off with zero. This kind of indicates it's a new business. Alright, the balance sheet. One thing we want to note, look at the date. It's not for the month ended January 31st like the other two are. It's only as of a specific date because this is a financial snapshot of the business at the end of business day on January 31st. It does the accounting equation where it has assets on one side and we put liabilities and stockholders' equity on the other side. Alright, let's look at the assets here. They split up the assets into two types, current assets and then property, plant, and equipment. Current assets are things that we're going to use up effectively within 1 year. So anything we can use up within 1 year is a current asset. Things like equipment or building would be under property, plant, and equipment. They're expected to last more than 1 year. So the cutoff here between current and long-term is 1 year. What it does is add up both types. So we add up all the current assets, add up the long-term assets here. Don't worry too much about this cumulative depreciation. We're going to talk more about it in chapter 3 and see it, but this is the proper treatment for it. It subtracts out of the equipment to get to its net book value. We add up those two numbers, we get to the total assets. Alright, for liabilities, we have current liabilities here. We see different types, accounts payable, wages payable. Notice unearned revenue. Make sure that we define that as a liability, not as a revenue account. Income tax payable, notes payable, interest payable. Notes payable is very similar to accounts payable, except it generally has interest associated with it. So that's why they have this interest payable account as well. But they add up all their liabilities. For stockholders' equity, there's two types. You have common stock and retained earnings. You add up common stock, retained earnings, you get to total stockholders' equity. Then you would add that to liabilities number. So this number plus this number equals the $88,060. And notice that's where it gets its name, the balance sheet. This balance sheet has to balance. Like if it doesn't balance, the accountant definitely made a mistake. There's no business in the world that should have an unbalanced balance sheet. Ever. Notice where the 5221 came from. It came from the retained earnings statement, right? So we have retained earnings 5221. So notice that relationship. Next page, we're going to get to the statement of cash flow. All I want you to do is recognize that this is one of the basic 4 financial statements. We're not going to go into it any more than that. You can see the three different categories: operating, investing, and financing. Don't worry, you're not going to have to make one of these. If you want, you can cross it out for the most part. Just define it as one of the basic 4 financial statements. Alright, the next part, we're going to define what a T account is. So T accounts are often used by accountants to understand a transaction better or determine an account's ending balance. And that's what we're going to do here. We're going to have a couple examples to determine the ending balance. It's just a joke. It's a complete mystery on why they're called T accounts. Maybe you can figure out why they are. Alright, the T account has a title at the top. In this case, where I'm going to show you an example in a bit of cash and accounts payable. The left side is always the debit side. Left side is always the debit side in the T account. The right side is always the credit side. And by definition, that's all debit and credit means. You can't define debit and credit as meaning any more than left side and right side. Debit means it's on the left side. Credit means it's on the right side. They have no further definition besides that. We're on the next page. We're going to get to normal balances, and that'll help make sense a little bit more of these two words. But for now, just know we put anything that's a debit on the left side, anything that's a credit on the right side of the T account, always, 100% of the time. Now, when we're done with all the transactions, we draw a line. This line indicates that anything below it is a balance and not another transaction. So if the debits are higher than the credits, then it's going to have an ending debit balance on this side. On the other hand, if the credits are higher than the debits, it's going to have an ending credit balance on this side. So you're only going to have a balance on one of the two sides, depending on which is larger. Debits and credits work like positive and negative numbers do in math. They cancel each other out. So they cancel each other out or subtract the two, and then it gets a sign of the larger one. So if the debits were larger, it gets an ending debit balance. If the credits were larger, it's going to have an ending credit balance. So they basically like positive and negative numbers in math. All right, let's see if we can solve this for cash. All right, on the debit side, we're going to have 600 plus 200 plus 75. So we're going to have a total of 875 on this side. On the credit side, we're going to have 100 plus 200, which is 300. So we have 875 on the debit side. We're going to have 300 on the credit side. What we can do then is subtract the two, 875 minus 300. And you get to 575. Now, which side is it going to go on? It's going to go on the debit side because these three numbers together are higher than these two numbers. So it's going to be 575 on the debit side. I'm going to write out the math that I used to calculate it. For accounts payable, we have 200 here on the debit side, but we have 800 on the credit side. 800 minus 200 is 600, and it's going to go on the credit side because the credits are larger than the debits. I'm going to list out the math for accounts payable. Alright, oftentimes students use negative numbers in journal entries or T accounts, but you really don't need to do that in accounting. Because if you think something is a negative debit, just call it a credit. So we don't need negative numbers. If you think something is a negative credit, just call it a debit. So we'll never put a negative number in here. We're not going to put this on the other side and call it negative 200. I know mathematically it would work, but it's just not, no one does it that way in the accounting world. Accounting systems aren't set up that way. So using T accounts or journal entries, we never use negative numbers. Alright, this page is the most important page of the chapter. If everything else I said goes over your head, make sure we get these 6 definitions down, the normal balances. So on the previous pages we defined the 6 different types of accounts: assets, liabilities, equity, revenue, expenses, and dividends. Every account must be defined as one and only one of those 6 types. So everything's going to fit into one of those, every account is going to fit into one of those 6 definitions. Alright, the normal balance of each account type are chosen so the balance sheet balances, okay? The normal balance of an account is either a debit or a credit depending on which one increases the account. So the normal balance of an account is either a debit or credit depending on which one increases the account. What we're going to do is just define which ones are debit and credit, and this is what everyone in America uses. They use these definitions. So assets have a normal debit balance just by definition. By definition, I mean, it's completely possible to set up an accounting system with the complete opposite rules here, but we're teaching you what everyone does in America, and everyone in America think that assets have a normal debit balance. We all follow that approach. So assets have a normal debit balance, liabilities have a normal credit balance, equity has a normal credit balance just by definition. What does this mean that it has a normal debit balance? It means that the debit side is the positive side. So the debit side, which is the left side, is the positive side. The negative side would be the other side, the credit side. So cash, if we want to increase cash, we're going to say that we're going to debit the cash account. Because it's an asset, a debit would increase it. If we're paying out cash and we need to decrease the cash account, we would credit the cash account. So that gives you an example of what it means. But once we know the normal balance, we know what side's positive. Once we know what side's positive, we know the other side is negative. So liabilities have a normal credit balance. So the credit side is positive. So accounts payable, if we bought something on account and accounts payable goes up, then we're going to credit the account. On the other hand, if we pay off our bill, once we pay our bill, we no longer owe that bill, so we reduce accounts payable. But for our purpose, we want to know assets have a normal debit balance, liabilities have a normal credit balance, equity has a normal credit balance. One way to think about this is seeing it like it cut off here. This is one side of the balance sheet. This is the other side of the balance sheet. One side of it, the asset side, has debit balances, and everything on the other side of the balance sheet has a normal credit balance. Alright, so that's 3 of them. Assets is a debit, liabilities is a credit, equity is a credit. Normal balance. For the income statement accounts, revenue is defined as a normal credit, expenses have a normal debit, and dividends have a normal debit. These 3 accounts are temporary in nature. and they're going to close out to equity at the end of the period. Revenue closes out as a positive to equity, so it has to share the same relationship. It has to have the positive, the normal credit balance, just like equity does. Expenses will close out to equity, but they close out as a negative, so they're going to have the opposite balance. In addition, you can, once you know revenue is a credit, it makes sense to think expenses are a debit. They have to be opposite. They are opposite in nature. So we have revenue as a credit, expenses as a debit, normal balance. Last one, dividends, has a normal debit balance. You can associate the D in the word dividends to mean debit. So dividends have a normal debit balance. But we shouldn't be able to get these in our memory. Assets have a normal debit balance, liabilities has a normal credit balance, equity has a normal credit balance, revenue has a normal credit balance, expenses have a normal debit balance, dividends have a normal debit balance. Notice there's 3 of each. I'm going to show you a little memorization trick. So we can take a word dead and we can make an acronym out of it. So we're going to use dead, which is a word, and this color, I know it's not a word, but it looks pretty close to a word. So we're going to use these 2. Dead starts with the word debits. The debit ones are expenses, assets, and dividends. So once you know that the other 3 are then the credits. So it's just an acronym you can use. But again, this is very important. You should be able to write these 12 words, because there's 12 words here. You should be able to write this on a quiz if you see it in some way or some form. It is really the most important thing to take away from this chapter, is the normal balance of the accounts. Because in chapter 2, we're going to be journalizing transactions. We need to know how to increase or decrease a certain account. We need to know whether we need to debit or credit it to increase it or decrease it. Alright, pretty much last page here, the ethical considerations in accounting. What we want to do, we want to define fraud. Fraud, whenever there's an action that has intent to deceive, that is fraud. So we can have an error in the business records. An error indicates that it was unintentional. So if it's unintentional, it's called an error. But if we do it with intent, intentionally try to make a mistake, then it's not a mistake, right? It's fraud. So if we intentionally make a mistake in the records, it's called fraud. There are 3 conditions. This is called the fraud triangle. So there's pressure. In order for someone to commit an unethical act, they usually have to have these 3 attributes. They have to be under some type of pressure or have other incentive. So they have to have a reason to commit the fraud. They have to have the opportunity to commit the fraud. Opportunity, they have to be in a high enough position or have authority over something or take advantage of weak internal controls, but they have to have some type of opportunity to do it. Third step, they have to be able to rationalize it. Rationalization, like Breaking Bad was a popular show. I know a lot of students have watched it. So the guy was doing unethical acts, but he rationalized it because he was doing it in the best interest of his family. So that gives you a good example of rationalization. It's some way of making sense of it. Another example is saying, well, it's okay that I steal from my employer because I'm underpaid anyways. I work so, it's a way of making sense of it. Alright, so how do they prevent or eliminate it? They use internal controls. If you go into accounting, you're going to see a lot about internal controls. Also, you have a code of ethics. It really matters a lot, the tone at the top of the bosses. If the bosses promote and act in an ethical way, it influences everyone under them. But if they're unethical or have loose ethics, then it influences everyone in that direction. So the tone at the top is really important for ethics. It says fraud is very costly to an organization, can lead to lower sales, higher expenses, and greatly damage an organization's reputation. That's very true. If there anything intentional misstatements on a financial report becomes public knowledge, investors will really downgrade corporation stock very quickly. Alright, the last page is it just stands for too long, didn't read. This is just a summary page where you can get most of the important definitions. This is kind of what you want to take away from the chapter. If you can have all this information down and take it into chapter 2, we're going to be in pretty good shape. But for this chapter, most important thing, have these down, know the normal balances, because we're going to work with journal entries next time. Alright, that's enough for Chapter 1 material. Let me know if you have any questions, and I'll see you guys next time for Chapter 2.